You're standing inside a Bank of Cyprus branch in Nicosia. It is March 12, 2013, a Tuesday afternoon. Your account balance shows 180,000 euros. The screen displays every single cent. The ATM outside dispenses cash without delay. The teller processes your withdrawal of 20,000 euros in just 4 minutes. You return on Thursday, another 20,000 euros, no questions asked. Then, on Saturday morning, a final transaction, 15,000 euros. The branch is busy. Other customers are depositing checks and paying bills. The manager sits in his glass office, reviewing documents. Everything appears normal. In 4 days, 55,000 euros moved. But you read something that others did not. It was March 11th. That was when the European Central Bank issued a critical statement. It declared that Cypriot banks required 17 billion euros in recapitalization, and that deadline was March 25th. Failure to recapitalize would lead to a liquidity cutoff. This was not a headline, nor was it a warning. It was a technical notice. It was written in cold, institutional language, buried deep within the financial press. Yet you understood what it meant. 6 days later, on March 18, 2013, the government announced capital controls. The withdrawal limit was set at 300 euros per day. Your neighbors suddenly could not access their savings. The money was still there. In the account and on the screen, the balance had not changed. But the system had shifted from one of access to one of restriction. The number remained the same, yet the ability to use it had vanished. The difference was not due to intelligence, nor was it luck. It was about recognition. It was about understanding one specific sentence in a central bank statement. It was about taking one action before the announcement became a restriction. The question had never been whether the controls would come. The only question was who would move first. Because banks do not collapse simply from hidden fragility. Banks do not collapse because of hidden frailty. They collapse after a period where fragility is measured, documented, and declared manageable. Cyprus in January of 2013. The Central Bank of Cyprus publishes its quarterly financial stability report. The conclusion? The banking system remains adequately capitalized under current stress scenarios. 2 months earlier, the European Central Bank issued a statement on Cypriot banks' exposure to Greek sovereign debt. The language was careful. The banks were operationally sound and meet regulatory capital requirements. December 2012, President Nikos Anastasiadis gave an interview to the Financial Times. Cyprus did not need a bailout. The island's banking system had weathered the Greek crisis. Tourism was steady. Financial services continued to operate. Gross domestic product contracted, but stabilization was projected for 2013. Here's the thing. The surface data supported this confidence. Bank branches opened daily. ATMs dispensed cash. Tourists filled the coastal resorts. Unemployment rose but remained below the Eurozone average. Depositors checked their balances online. The numbers matched their statements. Every operational indicator suggested continuity. This wasn't chaos. This was rational confidence built on institutional reassurance and surface stability. Iceland. In September of 2007, Prime Minister Geir Hard declared that Iceland's banking system was on a very strong footing. The 3 major banks, Kaupthing, Landsbanki, and Glitnir, held assets worth 10 times Iceland's gross domestic product. International credit rating agencies affirmed their investment-grade status. Argentina, March 2001. Economy Minister Domingo Cavallo announced that Argentina's currency board system, which pegs the peso to the dollar, was inviolable. The banking system remained liquid and solvent. Same pattern, same institutional language, same outcome. But one voice dissented. Cyprus, October 2012. Economist Fiona Mullen published a report. Cypriot Bank's Greek bond exposure had created a capital shortfall that no regulatory language could resolve. She calculated the math. Recapitalization required either sovereign bailout or depositor funds. Her analysis was publicly available, not secret, not hidden, but ignored. 3 months later, capital controls locked 68 billion euros inside the Cypriot banking system. Withdrawal limits dropped to 300 euros per day. The recognition gap had closed. The first signal is interbank lending withdrawal. Banks lend to each other every night. These are short-term loans that settle the next morning. Temporary imbalances get smoothed out through overnight borrowing. This is how the system maintains liquidity. When that lending stops, it means one thing: banks no longer trust each other's solvency. This is not visible to depositors. Your ATM still works, your balance still appears. But inside the system, institutions have stopped extending credit to each other. Here's where to look: central bank data, emergency liquidity injections, sudden spikes in overnight borrowing rates, and collateral requirement changes. Iceland, September 2008. 6 weeks before Kaupthing Bank collapsed, the interbank market froze. On September 15th, the overnight lending rate between Icelandic banks spiked from 15% to 18% in a single day. By September 29th, Icelandic banks had stopped lending to each other entirely. The Central Bank of Iceland injected 55 billion krona in emergency liquidity. Kaupthing's retail branches remained open. Deposits were accepted. The bank's website displayed normal operations. International institutional depositors, hedge funds, corporate treasuries, pension managers monitored these interbank rates. They read central bank liquidity reports. Within 2 weeks of the freeze, they had moved 2.5 billion euros out of Icelandic bank accounts to institutions in London and Frankfurt. Domestic depositors saw functioning branches. The international funds saw banks that had stopped trusting each other. On October 9, 2008, the Icelandic Financial Supervisory Authority took control of Kaupthing. Withdrawals were frozen that afternoon. Not months, not weeks, 24 days. When banks trust each other less than they trust the public statements they issue together, the gap is open. The second signal is balance sheet composition shift. A bank's balance sheet reveals what it holds and what it owes. The loan-to-deposit ratio shows how much of depositor money is lent out versus held in reserve. Sovereign bond holdings show exposure to government debt. When these ratios change suddenly, deposits flowing out faster than loans are repaid, or sovereign bond holdings spiking without explanation, the bank is responding to structural pressure not yet visible to the public. Cyprus, 2011 to 2012. Between January 2011 and June 2012, Cypriot banks increased their holdings of Greek government bonds by 4.5 billion euros. Not a 30% increase, not a 50% increase, a 300% increase. This was documented in quarterly regulatory filings submitted to the Central Bank of Cyprus. The banks presented this as prudent diversification into European Union sovereign debt. Here's what it actually was. Greek bonds were the only asset liquid enough to replace the deposits that were quietly leaving. Capital flight was masked by sovereign bond purchases. By December 2012, Greek bonds constituted 23% of Bank of Cyprus's total assets. These bonds had already been restructured once. Their value had declined 74% from face value. Think about what that means. A bank loading its balance sheet with impaired sovereign debt was not diversifying. It was absorbing losses that would eventually require depositor funds to cover. Depositors who read the central bank's financial stability reports saw this shift. They understood the mechanism. Most depositors did not read regulatory filings. They saw bank branches operating normally. By February 2013, informed depositors had moved an estimated 3 billion euros to banks in Greece, Germany, and the United Kingdom. On March 16, 2013, the Eurogroup announced capital controls. Withdrawal limits were set at 300 euros per day. The deposits were still in the accounts. Access was now conditional. When the bank's balance sheet starts looking like the government's, the bank has become a political entity, not a financial one. The third signal is regulatory language shift. Central banks and financial regulators do not announce collapses. They manage confidence. Their language is carefully constructed. Here's the kicker. When that language changes from declarative confidence to conditional compliance, the institution is acknowledging fragility without issuing a warning. Argentina, mid-2001. In March 2001, the Central Bank of Argentina issued its standard financial stability report. The Argentine banking system is solid and well capitalized. By July 2001, the language had changed. Argentine banks meet current regulatory requirements under present economic conditions. Let me show you the difference. One declares strength, the other declares compliance, conditional on circumstances not changing. Depositors who parsed institutional language saw the shift. Present conditions is a hedge. It signals that the institution no longer believes its previous assessment holds under stress. Same bank, same deposits, same regulatory body. Those depositors moved funds to Uruguayan banks and United States dollar accounts offshore. Most depositors heard meets requirements and stopped reading. On December 1, 2001, the corralito was imposed. Withdrawal limits, 250 pesos per week. The accounts were not frozen. Access was rationed. The gap between language shift and access restriction, 5 months. When the institution that has been declaring stability starts declaring compliance, the difference is recognition. Chapter 3. The Recognition Gap. The signals are public. The outcome is consistent, and yet the gap still opens. This isn't an information problem. This is a recognition problem. 3 structural barriers prevent depositors from interpreting what they can see. They are seeing the information, but they're not reading it correctly. The depositors who survived saw the same data. However, they read it differently. The first barrier is institutional constraint. Banking regulators can't issue public warnings. Such warnings would trigger the very panic they're trying to prevent. In September of 2007, the Bank of England learned that Northern Rock was approaching insolvency. They didn't announce it publicly. Instead, they arranged private liquidity support. They also requested media silence. The information leaked 4 days later. By the time the Bank of England issued a public statement on September 14th, depositors were already lining up outside branches. The queue itself was the warning. The institution that could have provided advance clarity was structurally prevented from doing so. The second barrier is the expert consensus trap. The economists and analysts employed by the banking system can't see the system's structural fragility because their analytical framework assumes institutional continuity. In Iceland, domestic banking analysts maintained buy ratings on the 3 major banks until the week of nationalization in October of 2008. They weren't being dishonest. They were simply working within a doctrine that made recognition impossible. The third barrier is surface functionality bias. Depositors interpret operational continuity, working ATMs, visible balances, open branches, as evidence of structural stability. Both conditions can coexist during the gap. The system doesn't announce its fragility. It continues to function until the moment it stops. The information was available to everyone. But the true access, the correct interpretation, was not. When the institution that has been declaring stability starts declaring compliance, the gap is closing. The 3 signals are clearly visible right now. Though not in every jurisdiction and not in every bank, they are present in specific institutions where the conditions align with the historical pattern. First signal, interbank lending withdrawal. In March of 2023, Silicon Valley Bank failed. Overnight interbank lending rates immediately spiked to 4.83%. This was the highest they had been since 2007. The spread between overnight rates and the Federal Reserve's target widened to 58 basis points. Regional banks then abruptly stopped lending to each other. To combat this, the Federal Reserve injected $152.85 billion through the discount window in a single week. This is an emergency lending mechanism used when banks cannot access the normal interbank markets and when trust between institutions collapses. Here is the key point. The mechanism matches the historical pattern exactly. Institutional trust collapsed before depositor panic even began. The signal actually preceded the restriction by 72 hours. The interbank market knew, but most people didn't. The second signal is balance sheet composition shift. United States regional banks currently hold $620 billion in unrealized losses on their bond portfolios. Keep in mind, this is not an estimate. It's documented in the FDIC's fourth quarter 2024 data. When interest rates rose from 0.25% to 5.33% between 2022 and 2023, the mark-to-market value of bank bond holdings collapsed. However, banks did not sell. Instead, they moved these securities to held-to-maturity accounting categories. This way, the losses do not appear on regulatory capital calculations. It's the same pattern, the same mechanism, and the same accounting treatment seen in the past. Banks hold sovereign bonds at their face value, even while the market value deteriorates. This accounting method conceals fragility, which only becomes visible when deposits are withdrawn and bonds must be liquidated. This isn't about the bonds being bad. It's about needing your money. The third signal is a subtle shift in regulatory language. Consider the FDIC's statement issued on March 12, 2023. It stated that, and I quote, "The United States banking system remains resilient and on a solid foundation." Note that it did not say sound, strong, or well capitalized. The addition of the single word "remains" marks a shift from a simple declaration of fact to an act of reassurance. The institution was no longer stating a fact. It was actively countering a negative perception. Now, consider the math. These same conditions have preceded collapse in every documented case. However, not every instance where these conditions appear results in a collapse. But every collapse has been preceded by these conditions. The difference wasn't ever about the information itself. The real difference has always been in how that information has been interpreted. Chapter final. Panikos Dimitriades never withdrew his savings. The Central Bank of Cyprus governor spent March 2013 issuing statements of confidence. The banking system was sound. Depositors' money was safe. The fundamentals were strong. On March 16th, capital controls locked the system. Withdrawal limits dropped to €300 per day. Your account showed €100,000. You could access €300. Here's what Dimitriades did. His personal accounts had been moved to London weeks earlier. Not because he possessed secret data. The interbank freeze was documented. The balance sheet exposure was published. The Basel compliance reports were public. The regulatory language had shifted from confident to conditional. He recognized what the language meant. He understood that central banks cannot warn without triggering the collapse they are trying to prevent. That surface stability and structural fragility coexist until the morning they don't. That the gap between operational continuity and access restriction closes without announcement. The difference was not intelligence. It was not inside information. It was recognition. Banking collapses do not occur without warning. They occur after the warning has been issued, in language designed not to be understood. Dimitriades issued the reassurances. He did not follow them. Not dishonesty, but pattern recognition. The signals are always there. The question is whether you're reading them or waiting for someone in authority to translate. If this analysis was valuable, subscribe. The next episode examines the 3 conditions that determine which crises become contagious and which remain contained.